Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of IWM, which is the iShares Trust for the Russell 2000 ETF. As you can see here, I left my lines on the chart from last week, where this 210 level was our resistance point, and I pointed out that the market here is basically within a well-defined trading range. So we pulled back from that 210 resistance. It started to pivot. Today we have this very small candle, almost a spinning top, which is a sign of indecision. And if you look down below, you can see that the oscillators are still moving lower, particularly the stochastics oscillator. So what does that mean for next week? Well, there's nothing really to say except that I'm going to keep this target in place. It's almost at a Fibonacci retracement pullback point. And remember, because the market is in this trading range, it will most likely oscillate. Now, one other thing, if I zoom in here, you can see there is a small gap down there right around 197. So that too will act like a price magnet. You can see that back in time here, early in the week, the market's gapped up, and then what happened? The price came right back to fill the gap. So that is a good indication down here that we could go lower as that draws the price to that gap fill. And then we'll have to see whether or not the price reverses. A lot of times the price will reverse after the gap fills because it's reached the target price for swing traders. And then we go through the cycle again looking for the next gap. So that is IWM. If I take a look at the Qs, QQQ, it's pretty much the same story, with one exception, is that we had a resistance point up here. We did break out of that resistance, and we saw an increase in volume here. You see that? Now, this resistance, now that it's broken, will most likely act as a support level. So I have to keep that in mind from this high. As I remove this, what I'm going to do is basically draw a new role reversal up here. See that? We have former support, broken, turned to resistance, held as resistance. This too, right smack dab in the middle of the trading range. This is, I measured this earlier today. This is right around the 50%, just a little bit below the 50% pullback point on Fibonacci's. So I have to keep an eye on that. One interesting thing about the Qs, and I'm going to go to my moving average crossovers here. You can see again, this is the Qs, and this red line right here, you see that red line, that is the 100-day moving average. And we are just about a couple of days away from that crossing, and when that crosses, we do get computer selling that comes in. We'll have to see how far that pushes the prices lower, but that 200 period moving average and the 100 period moving average both acted as resistance this week. So again, nothing has changed here. It's just like what we saw in IWM, where I'm going to keep that price target in place to see if we get that pullback point to, again, the Fibonacci retracement. So that target is still in place at 338.39. Now, if you're an option trader of ours in our membership, you'll know that we are trading put spreads, and this is a great opportunity for option traders because for as long as the markets stay within these trading ranges, we make money from time decay. That's known as theta. All right, if you're interested in learning about how to put theta on your side, how to make money from time decay, then make sure you check in with Market Rebellion, check with one of the representatives there, and get into one of our free webinars. I do those often with John Nigerian and Pete Nigerian, and see whether or not these services are something that you might want to pursue. All right, moving average crossovers are a big deal. You can see that back here. When the 20 crossed the 100, prices dropped. When the 50 crossed the 100, prices dropped. When the 50 crossed the 200, you can see here prices dropped. Now this 20 period moving average, remember that blue line is going to be trading most closely to the price action. So that's why that one's heading up. But if we start dropping back down below that, that moving average is also going to turn lower. So this level down here, for anyone who's long the Qs or the tech sector, 317 is a big support level. Because if we back out with the weekly charts here, you can see that that is a very important support level. And notice the weekly moving average, that's a 20-week moving average. You see that? That is a shooting star. That's a very bearish candle right at that major moving average. You see, so again, keep your eye on the charts. Make sure that you are managing risk. This is not a time to be taking shots in the market. I still think that long term we're going to see much lower prices. And again, our members are positioned to make money with spreads. And the great thing about trading spreads, even put spreads or diagonal put spreads, is that even if the market goes against us slightly like we had this week, we're still making money because of time decay. That's really a great thing. So that is the cues. If we take a look at the diamonds, look at this on the weekly chart. You can see, again, same thing. We have this long shadow above the market at a resistance point right here. This is the weekly chart now. And you can see that my halfway point, this is a Fibonacci retracement level. This is still going to be the target that I'm keeping in place for the intermediate term. Long term, I think we are going to break out below that low of 322. And then we'll have to see how the momentum shapes up at that particular point in time. Now, if I go to the spiders, again, I'll stay on the weekly chart because I want to also look at the VIX. If we look at SPY, same thing on the weekly chart. This is very close to a shooting star. You can see that we traded up to that resistance and then came right back down as the sellers pushed it back below that resistance point. And now we have the CCI and the stochastics going up, but the stochastics, this blue line, the percent K, is starting to veer and diverge from the percent D. So when these get really wide and separated like that, it becomes much more bearish. So again, I'm keeping that target in place right there at 430. I could, again, just draw a horizontal line, keep it that way so we won't have to keep moving those lines. But that, again, is almost exactly halfway within this trading range. And another thing I want to point out about the spiders is that notice how the moving average here was acting as support, support, support. And the role reversal is kicked in. So now that moving average, now that the prices are moving below the moving average, that is going to act as resistance. And you can see here today and this week, we had that as resistance once again. Now, let's go look at the VIX because I want to look at the VIX on the daily chart. And I'll switch to my daily charts right here because this week during one of the webinars with our members, what I did is I took the VIX and I put the cycle brackets on, and I think you're going to find something very interesting here. In fact, what I'm going to do is go to a 4-year daily chart and then zoom in here. Now, I want to show you something very interesting. If you have a Thinkorswim platform, what you do is you go to the drawings here, click on Drawing Tools, and go all the way down to the right. You see it says Cycle Brackets. Now, I'm just taking the lowest of the lows on this chart over the past year. But you can see that if I start my cycle bracket right there on that low and I drag it out to the right, what I'm doing is I'm basically eyeballing what's happening with that cycle. And again, look what we see. Very, very interesting is that had you bought the VIX on any one of these cycle lows, any one of them, you would have made money 100% of the time buying the VIX. See that? It went up. On this cycle low, it went up big. Here, you would have made a lot of money if you bought the VIX. Here, again, if you bought right here, even on that breakout, you would have hit the high for the year on the VIX. And where are we right now? Right exactly at a cycle trough. Now, if I go back, watch, this is what I did early in the week. If I take this and I just kind of shift it over, look at how consistent this is right here. Look at this. Had you bought, even back here, if you had bought on these cycle lows back here, you would have plateaued here, you would have made money there. If you bought here, would have dropped a little bit, but you would have made money here on the VIX. If you bought calls, that would have been a great deal for you. Take a look at this one. On this cycle low back here, all the way to the left, you can see how these match up. If you had bought on this cycle low right here, look at this tremendous profit you would have made buying the VIX. And so this is what we are seeing, and I'm going to keep that in place. Of course, I can't give you a 100% guarantee that the VIX is going to rally, but the other thing that I'm seeing about the VIX, and something to make note of, is that we have the widest divergence now below the moving average that the VIX has had in years. This is the widest price divergence below that moving average that we've had. Therefore, the rubber band effect will most likely start pulling this back up towards the moving average. So keep that in mind. Now, remember, for the most part, the VIX is inversely related to the S&P, hence the reason why we have put spreads on the S&P. Again, if you want to learn options, just plug into Market Rebellion. It's a lot of fun. We do one-on-one coaching. We do group coaching. We do webinars each and every week. I put trade alerts out. It's a lot of fun. And you could fit right into our culture of traders, swing traders, technical analysts, and have a great time with this market. So with that, just keep one other thing in mind. The week after next, we're going to be seeing some inflation numbers. That's going to be the week of expiration Thursday, because Friday the 15th is Good Friday. So expiration is going to be on April 14th. And when we have that happen, especially with long weekends that follow during the shortened trading week, we generally see volatility increase during that time. So it's going to be very interesting as we move forward over the next couple of weeks. So with that, have a great weekend, and we'll talk to you soon. So long.